Do you know the 4 ways to actually make money in trading? Well, in this episode of Systematic Shenanigans, Pedmer and I break down these 4 proven methods that have been used in funds and for retail traders as well. We'll also discuss which ones we would be using based on different account sizes, so you can see which one would be more effective for you. Let's get straight into this episode. So I think we're going to start off first with the most important topic, which is there are 4 ways to make money in trading. Now, we'll also maybe go over some caveats around this, but this is primarily from a Twitter account called Systematic Long Short. He originally wrote this around a person tweeting around if algorithms work, why do these sort of like particular patterns always stay true or whatever? And he was saying that these are the main 4 ways of making money, and I think both Pedmer and me heavily agree with each one of these. So I thought it would be great to kind of break through each one. Pedma, do you want to go with the first one? You're selling a service, then I can go with risk premium, and then we can kind of go off one and on.
Yeah, for sure. So I think I haven't seen a tweet this concise and that tells you exactly how to make money in markets. The details you have to dig for yourself. So of course, no one is giving you alpha or edge, but in terms of the abstract or overall idea of how to make money in trading, I think these 4 are really good. And the first one is you are selling a service, example, providing liquidity options for willing buyers. So this type of way of making money in markets is a more complex and hard way to do it because there's usually a lot of competition, especially on the major markets. These include stuff like he said, providing liquidity, doing market making, some HFT, selling, buying options, wherever. Everything that you can do to make markets easier to trade, those are services that are usually well rewarded for the market. For example, I'll give you a very simple example. Imagine that you are a real estate person and your business is buying houses and buildings at a cheap price and selling them at an expensive price. And you help people that want to get out fast of a position of an investment, and you buy them cheaper for your service and then sell them higher. Stuff like that, but in the markets. And since markets are engines that are pretty efficient and are always trading, right? These are usually very highly competitive areas because you'll be competing with teams filled with engineers and researchers. So it's usually not the best way for a new trader to go unless you are willing to go to less efficient markets. And I've seen retail traders do very well market making in crypto, and not only in crypto, because Binance and those top exchanges, you can't really market make there anymore unless you are really good again. But if you are willing to go to shadier exchanges, lower liquidity exchanges, and provide liquidity there, that's an interesting idea for these type of trading strategies.
Yeah, 100%. I think you summed it up perfectly. Then number 2 is risk premium. So we've talked about risk premiums quite a lot on these podcasts, but as a general summary again, this is primarily you earning something for doing something risky with your cash. So this could be buying growth stocks, and you're having to hold them through the ups and downs. And we've also talked about it in the way that Ewan Sinclair talks about it, where it's like having $100 in the middle of a highway, meaning that everyone has probably seen that $100, but no one's really taking that risk to get that $100, as there's risk associated with going across the highway. So if you're willing to take on that risk, then you can get rewarded with that $100. There's many ways to do this. I would say this is most applicable to futures, equities. It's obviously applicable to crypto as well, but most of the time in crypto, you can actually find more unique inefficiencies compared to something in like futures. You're not really going to find pure alpha in futures. It's very difficult to do, at least from my findings. Most of the time, you're going to be doing something that's quite risk premium around trend following or maybe even some mean reversion, and you can get paid for taking on that risk during that time. I would also say this is probably where most traders actually make their money. It's probably where, at least for me, I probably make 80% of my money through risk premiums, maybe even a bit higher. And I think Padma, you're probably around the same percentage, right?
Yeah.
So it's, for the most part, I think most profitable traders earn a lot of their capital and P&L from this. Now, they may not understand that they're actually making money this way, but for the most part, if you're trading any of the major markets, it's probably going to be some percentage from this. And then do you want to go over the third one?
Yeah. And if I may add on the 2, even like your how can I say it? Your small caps equities, like micro cap equities, like shorting trash companies, even that I would consider a risk premium, because to me it is, unless you are doing something very specific and you can get, can I say it, an absolute return above it, a risk-adjusted return above what's expected from that space. But even that, like everyone knows that those companies are trash and that they are going down, but not everyone is willing to take the risk to short it, right? So there's usually people conflate alpha with risk premium. We talked about it a lot, but most of the time it's just like you said, that example from you and Sinclair is perfect. If there's something available on the table for you to make money on, and you know that everyone knows about it, because this was also very something that I questioned myself when I was a newer trader back then. I was like, okay, but this is all over the internet. Why do you make money trading short side of microcap equities? It is a fair question, and that is because it is a risk premium. That's it. Yeah.
Yeah, I'd also say, just to add one thing on that, a lot of people, especially when they're new into trading, I think they view trading as you don't have to take on that much risk to make money. I think a lot of people underestimate that, how much just taking on risk itself is the reason that you can make money in trading. A lot of people want that idea where you have a 90% win rate, you never have big losers or anything. And that's most of the time, if you are trying to look for a system like that, they either have to be a pure inefficiency or they just don't exist and someone's kind of selling you a lie for the most part.
Yeah, for sure. Like if you want to grow an account from, and this is not a topic for today, but if you come to this space with a small account and you don't have a lot of money yourself, you're a young guy or not, and you don't have a lot of cash, like the only way that you're going to grow it is either by adding to it, adding cash and taking small bets over time, or you're going to have to take a lot of risks, right? Even in business, you see this. I see this channel from these entrepreneurs, like that they came from anything, from nothing, from poverty sometimes, and they grew multi-million and sometimes billion-dollar companies. And you can see that all of them did something risky. Sometimes they went into debt to be able to grow their companies and stuff like that, stuff that would like keep you awake at night. But that's the only way that we grow capital when we are starting out. And that's it. Risk is inevitable. Embrace it.
Yeah, 100%.
So you have the number three way of making money is you have an information edge that comes from either having access to data that the dollar weighted average participant do not, and I will explain that, or are able to transform and extract excess signal from contested data. So what he's saying here is basically that you are not going to find alpha on open, high, low, close bars. You are just not going to find there because everybody has squeezed all amount of information that you can get from those from that data. Even myself, like I've created machine learning algos that search for millions of combinations in a few hours of different patterns, whatever. Like you are not going to find that. So what he's saying here is you either have an information edge that you are able to extract from sources of data that are not readily available for the average market participant. So for example, one of the examples that just comes to mind, I have a few, but one of them was when hedge funds started to buy like satellite data to track how many cars were in front of different stores. For example, if they had a month where you had like 50% more cars on a parking lot of a mall or something like that, you could predict that the prices for those companies probably in the next month or whatever they predicted would be much higher because there were a lot more people on the parking lot ready to buy from that mall or that shop or whatever. So that's information that you and me as retail traders, we don't have access to. And that's basically point number three, is that you have an information edge from information that the dollar weighted average participant does not. What do you think, Munir?
Yeah, I totally agree. I think it can apply, like you were saying, with using kind of alternative data, and that's how you get your kind of unique edge around it. Or it can be, I, I, I think this would be true, is that you can have more contextual knowledge in that particular thing. So I'm kind of thinking of like the jelly trade, right? Where unless you were there at that right time and you understood why that trade is taking place, that's why there was like an inefficiency that you could take advantage of. Would you agree that's more an inefficiency, or would you classify that as like a sort of risk premium, as you are taking on, technically just risk over there for the hyperliquid side?
No, I think that was pure alpha.
Yeah, I agree.
Yeah, even talking to other traders around us, they were not getting the same intuition that we were because we were deep into it. It is pure information that others don't have access to.
Yeah, I think that kind of perfectly sums it up. Should I move on to number four?
Sure, please.
So number four is mainly around structural edges. So this is that, as kind of Pedro was saying, is if you have something that's structural that the normal dollar weighted average participant doesn't. So this could be VIP fees. This could be better data feeds. Back in the day, the primary edge that a lot of quant funds were using were just faster data connections to the actual exchange. So if you could submit an order and front run it compared to other people's orders, then obviously you can make the difference between there. And that's what a lot of the initial edges were. Now, obviously, over time, those have been beaten down because more and more people have tried to compete on speed. So now you need to have even better infrastructure and you need the highest, most expensive data cables, etc. But those are main ones of structural edges. You could probably also classify that as structural edges if you're taking an exploit from newer exchanges that are being deployed, as they could have structural weaknesses that then you can have an edge on, for example, and that's more apparent in crypto than really anywhere in equities and futures. But I think that's a summary. Anything you want to add on number four?
Yeah, it's like so number four and number one are very correlated because these are for the big players, in my opinion, the more sophisticated players. And for example, if you can shave off your fees like a few BPS because you have a firm and you can bring a lot of volume and exchanges give you that advantage, like maybe for me and you, it's not a big deal, a few BPS in cost, but maybe for a firm that does $1 billion, $10 billion volume a month, maybe that's a few million in P&L every year that they save, and that's important to pay salaries and everything else. So yeah, the number one and number four, I think it's more applied to more sophisticated players. The number three as well, even though less so, because even you and I can go on chain and find these type of information advantages that other people can't. So it's not like we are barred from there. We just have to dig deeper. And I think that number two on the risk premiums is where most people should start. Is no, okay, this is a risk that more sophisticated players don't want to take, but that I can take and that I can start making some money on. And I think that's where I focus on and where most people should focus on.
Yeah, no, I agree. It's kind of like in last episode we were talking about the difference of that. Not everyone should aim to trade like a fund, for example, because a lot of time, as you were explaining, a fund is having a large amount of capital and they're making very low margin trades, but that obviously adds up a lot in P&L because of how much size they're pushing. And it also goes back to the phrase that like if you can save $1 on commissions, that's like $1 straight to your bottom line. You don't have to take on any more risk for that. It's simply negotiating with your broker. While it seems like the most boring thing to do, it really can be worth it if you're starting to push enough size. Obviously, for a small trader, it doesn't really matter too much. But even if you are a small trader, trying to pick the best brokerage that has the lowest commissions can really add a lot to your particular P&L, or save you a lot of money as well. So those are things you should always kind of keep into account. I think we've also talked about before that ideally keeping kind of like a P&L book of just all the costs that are associated with trading and all those sort of things, then you can identify, oh, I could maybe save some money here because this X platform I don't really use anymore, or all those sort of things. Because back in the day, I was spending money on, I don't know, like 10 different softwares, and then I ultimately cut it down to just like three or two, because I didn't need all these extra tools that I actually wasn't really using. But there's a lot of things like, I don't know, like maybe like Bookmap. Like for me, at least for my personal style of trading, I really didn't need Bookmap, but Bookmap was a very exciting tool to use. It was very interesting to look at. But ultimately, was it providing me edge? Was I actually trading from it? No. So it was just a cost I could eliminate quite quickly.
Yeah, exactly. You have to treat your trading as a business. For example, the most recent example is I'm trading more and more on Hyperliquid. I mean, most of my trading is now done on Hyperliquid, and their fees are already more. They are cheaper than the highest centralized exchanges. And on top of that, I'm getting a rebate. I'm not going to say how much because then you can figure out how much I'm holding. But if you have a lot of capital staked with Hyperliquid, you get up to like 40%, I think, up to 40% of fees that are taken off from that are removed from you after paying them because you have so much staked with them. So all of those things really add up at the end of the year.
Yeah, 100%. I think the only thing I want to add onto this, not necessarily as another way to make money, but the point that everything else apart from really, I would say, two and maybe one of the ways to make money. So that would be risk premium and doing a service. most of the time the rest are very limited exposure and limited time that they're available. It's very rare to find those for a very long extended period of time that you can push as much capital as you would like through it. So I always think back of when you do see those events, as we saw with Jelly Jerry Trade and a couple others, more and more in the future, I want to try to take further risk on those because I know they are very a limited time event. You don't see them every day, you don't see them every week, you don't even probably see them every month, depending on how hot the market is. So when you do see them, if you have been trading well and you actually understand how they work, it's always worth to kind of put that actual solid size through it. Otherwise, you'll probably have to wait, 6 months or something until you see a solid opportunity again.
I know, yeah, completely agree. I know of teams, trading teams that focus on this type of inefficiencies, like stuff that can be considered alpha most of the time, and all they do all day, every day, is going through Twitter, going through documentation, reading new projects, like being plugged into every type of Discord, like of a fundamental Discord, checking new protocols, see if they are mispriced, see if there are inefficiencies. That's their job all day long. And that's their trading. They are always trying to find new inefficiencies because, like you said, these type of trades will go out all of the time. Like they stop working because other teams, other people figure out and they close out the edge, right? So you have always to be innovating, which is an interesting game. Don't get me wrong. It's very interesting, but it's a job.
Yeah, it's also very boring for the most part. Like I
Yeah,
do find researching like really fun, and I always love exploring new ideas with you. But waiting a long period of time until you see another like really exciting inefficiency, it can get boring at times. But I think also that's why you have to have a true kind of passion and love for trading because a lot of people advertise it as the perfect job. You can make money from anywhere. You can pick your own times and all this sort of stuff, but ultimately that isn't it's I would say it's like 50% true because obviously yes I don't have to stick to some 9 to 5 routine or anything like that, but also if I'm not awake when there's a particular inefficiency that happens, then that's costing me P&L. So it does become quite a strenuous game where you kind of have to always be on top of things, and if you take some time off you have to be really okay with the idea that you could miss out on amazing opportunities.
yeah. Even last night, like this could be automated, right? I said that I run like a manual trend model, one of them, and I woke up like at 3 a.m. or something to put orders in and to check my positions, and it took like half an hour, almost 1 hour to get everything like to check everything and see if everything is going nicely and stuff like that. But when the market heats up, sometimes I wake up in the middle of the night and I go check if everything is in order, and that's part of the job, right?
Yeah, 100%. At least for me, I always like automating risk premiums. Like all my futures algorithms are just automated, so they just take trades for me. But for inefficiencies, I am more on the side of that. I think it's quite difficult to automate them for things that are actually pure inefficiencies. I think a lot of people are just kind of saying they do mistake what a premium and inefficiency is. But just from our findings, a lot of the inefficiencies really don't last that long. So by the time you set up some way to automate it, they're often sort of gone or just not as well to capitalize on.
No, do you? Yeah, yeah, no, no. Yeah, unless you do this professionally and you know that it's going to last for a few weeks or months or whatever. Other than that, just go into the order books and extract whatever you are seeing, because it's definitely not worth it to be waiting a few months to get everything perfect aligned, and probably you won't even get it. While at the same time, the guy with an Excel sheet and just punting size around is doing all of the money, right?
Yeah, no, it's totally fair. All right, should we go on to the human input bias?
For sure. Yeah. So we were talking about this before. I'm not going to name names, right? But one of the things that I've been seeing on Twitter is with all of these craziness from the new administration in terms of volatility in markets and news headlines and stuff like that, a lot of people have allowed their preferences for the current US administration, whatever that preference is, like to influence their trading decisions. Even very smart people that run full professional quantitative models, I have seen talking about like messing with their exposures to US equities and at times really close them. I've seen some close their equities exposure right at the bottom of the market, like when it started crashing because of the tariffs. And I'm like, and that just showed me that even the most professional people, like smart people, and we are not talking here about the average retail, like even them allow sometimes to allow their biases and their fears to get into their own trading. And I think that even him said on the podcast that I heard that most of his discretionary decisions, the net result of his discretionary decisions is the net loss. And I think that's true for everyone else. And I've seen some very bad decision making from very good traders that I respect, but that have allowed their fears and biases to get into their trading. And yeah, I don't think that's good. Yeah, what do you think,
I,
Munir?
Yeah, no, I would agree. I think being a simpleton in some manners with your models is always the better approach because it's always good when you look back at like historical, just the historical SPY curve of all the different events of all the different things people have gone through and how it looks at that period of time, like the end of the world. It's going to be the end of the U.S. market. It's going to be the end of this, etc. And now, obviously, at some point, that will maybe happen. It could be the next 100 years, it could be the next 200 years, whatever. But obviously, at some point, it will stop. But at least for now, with all the data we have, it shows very decent proof that you just have to stick with your model most of the time and allowing these other biases come in like the tariffs and all these sort of things fundamentally will ruin your system, and as you're kind of saying, it'll be a net negative on your actual equity curve and how you actually perform. I'd also say for the most part, how I viewed it is that i I had the fundamental belief that I don't think Trump would let the market be worse off when he ends his term. Now, obviously, that's a bias in itself. Now, obviously, that's just my opinion of it. But I just couldn't see that he would tank the whole market to where people were saying it's going to be down 50%, down 60%. And you kind of saw it that when it was down even about 20-ish%, he started to do tweets of saying, oh, this is going to be better, or we're going to be doing this or whatever. And that would artificially pump up the market. Now, obviously, a lot of those were retraced and then pushed up higher on later news. And don't get me wrong, Trump markets are wild. They've been very difficult to trade. So many overnight gaps have been insane. It's all been basically news/event driven. So it's been very difficult if you're trying to trade anything discretionary or if you're trying to do swing trading systematically. It's been very difficult, at least from what I've been hearing from other people. So there are negatives to it. But for completely adjusting your model and everything, I don't really believe in that. The only caveat I'll say on that is I did stop taking as much exposure on my swing trades. And that was because a lot of it was just news event driven and there was way higher volatility than really any other previous time that I was testing it. So I had to reduce a lot of exposure on those. But apart from that, I've just kind of stuck to my models and continue trading it. And that's been the best thing, at least currently, for my equity curve.
And we did buy on the way down, right?
Yeah, true. Well, that was on
Yeah.
long-term portfolio. It wasn't really like me
Yeah.
trading it,
And
I guess.
and it's all documented on Twitter. Yeah, on long-term portfolio, also added on all the way down. It's like you said, there will come a time where maybe the U.S. economy stagnates, whatever, for a decade. That has happened in the past. But odds are that you are not going to predict it. And
Yeah.
if you are going to be doing that all the time, like you're going to be a net loser, even if you predict the top, even if you say, okay, the economy will stagnate and you are right. Okay, but what about all the other ways in the past that you said the same or other people said the same and were wrong? How much upside have you missed for that? And that's what you have to consider is long-term P&L, cumulative P&L, not the P&L of today or this quarter.
This actually brings up one topic I so wanted to discuss. I haven't thought about this as deeply, so please let me know if you think there's faults in my thinking of how I'm looking at it. But it has infuriated me with the amount of people on Twitter that have put takes of like the last time SPY did this, it did this, and their sample size is like 2 or 4, and it pisses me off because I'm like, well, great, we now know 4 events that were completely separate. We have no idea what the actual event was back then. And then they're comparing it to today's events of the same thing. Now, obviously, I do agree that if you look historically over the sample size, when SPY is down 15%, 20%, often it will revert as we get lower, right? There's going to be some sort of mean reversion. There's going to be a bounce back, at least with current SPY data. But to say that, hey, last time SPY did 3 days of X thing, it did this, it pisses me off because it's like a 2 sample size. What's that really going to tell you? It tells you nothing. It could be a 50-50 coin flip of what's going to happen next. Do you think that's correct thinking, or do you think anything flawed with that?
Yeah, I definitely do. I like to read books on like human behavior. And I don't know, it's just a topic that interests me. And one of the things that is always common is like humans seek certainty in everything, and that's why we look so much to stories. Like we always like to tell stories about something, even if we tell them to ourselves to justify our actions and behaviors and stuff like that. We all tell stories, and it's the same with trading. People like to tell stories about why this particular trade or event should happen this way, and they tell all kinds of stories like this happened in the past and so this should happen and stuff like that, when in reality markets are like ever-changing entities with where statistical relationships are very thin, even if it's existent. And especially when you use like one or two data points to justify it, you can't allow those type of stories to get into you. You have to look at an event like its own event and independent from other past events that are similar or wherever, and make your evaluations on risk based on that if you are going to trade it.
Yeah, I totally agree. The best discretionary trades are often where there's the lowest sample size because you have no really data to go off. You have to go off a bit of intuition, go off a bit of experience, and it's not what we like to do, but that's kind of the main way of doing it. Or you can look at it at like the fundamentals. Like when we were doing inefficiency trades, we more looked at the fundamentals of what we know and why this would work because of that. Even though that there wasn't many samples for us to actually look over.
Yeah, it's not like we're saying, oh, this meme coin went to 100 million market cap, and so if this happens, this one will also go. No, we are not looking at that. We are looking, there's a constrained buyer or seller, and we are going to be taking the other side to provide them liquidity to exit on. That's the fundamental belief of a trade like that. So, yeah.
100%.